Hello, everyone. Thank you, everyone, for joining us today. We are about to start. So if you want to leave in the chat where are you from and from where are you watching us, we are happy to have you all here and to get to know you better. So we encourage you to let us know. We have Martin Chera with us today talking about Express Capital Financing brings you rental 360. So we're going to wait one more minute so we make sure that everyone else join us. We are Real Estate IQ. Your deal is our mission. So we are deal maker and dream maker, and we provide the best real estate solutions committed to help one more person to win. So make your deals come true. Also, feel free to answer the poll that appears in your screen so we get to know you better and we know if you are an existing Real Estate IQ subscriber. We also provide these solutions off-market leads, EBA, CMA, custom leads mining, and virtual assistants. So if you're looking for more, please try our exclusive membership. And these are our social media accounts where you can follow us as well. We are in Instagram, Facebook, YouTube, and LinkedIn, and you can use the QR codes that appear below of each icon so you can join our community. And also you can subscribe and join us in our newsletter by scanning the QR code that appears on the right side of the screen, so you don't miss any of our weekly webinars and in-person events. You can also get a free 30-minute in-depth consultation of Real Estate IQ's services with one of our experts by scheduling it now, scanning the QR code that appears in the screen, and also by answering the poll in the screen as well. And this is a very short video of what we do. Okay, before we move forward with Martin, we have Orville with us today from our sales team that he's gonna do a short demonstration of the portal. So Orville, moving forward to you.
Thank you, Maria. Hello, everyone. In just a couple of minutes, I will demonstrate how our off-market leads can boost your deal finding. All right, so we provide two kinds of off-market, the standard and the premium. Let me share this screen to you. Right, so this is what you'll get with our premium off-market leads. Number of off-market listings, that's up to 10. Exclusive access, real-time update, real estate investment training, that's unlimited. Free tech support, investor community. Property offer, that's already up to 7,000 leads per month. And that also includes skip tracing data, such as up to 5 email addresses, up to 5 cell phone numbers, and up to 5 landline numbers. You will also get the information coming from the nearest kin of the property owner, name, numbers, and email addresses. Also, we offer statewide or metropolitan specific area data. For the state of Texas, we offer up to 7,000 leads per month. And our skip tracing accuracy and hit rate percentage is 80%. Now, primarily, we cover single-family properties, but for Texas Premium subscription, you will also receive extra benefit, such as commercial off-the-market leads. Now, we have a software, we call it the portal. And so here, this is where you will receive all of your leads. We'll provide you your login, and so you can filter it by criteria. So you can see here, pre-foreclosure, probate, earthship, tax sales, evictions, divorce, loan modifications. You can also filter it by city or by county, or you can filter it by auction date, or by date added, date filed, or record date. All right. And after that, you can click search, and then you can export it or download the file through a CSV file or Excel spreadsheet file. All right. And so we also have the portal comes also with exclusive content here in the Academy. So this is also, which is, educational part of Real Estate IQ, exclusive webinars, additional workshops, short-term rental workshop webinars, and a lot of extra content, which is helpful for you to build a strategy in your real estate business. So you can watch these videos in your spare time. All right. So if you are interested in getting, details of this, you can fill in the poll or type Y, and our account managers will reach out to you for help. Thank you so much, Maria, and I'm gonna give back the floor to you. Thank you.
Thank you, Orville, and thank you everyone for being here tonight. Martin, we are moving forward to you.
Beautiful, beautiful. Okay, thank you, Maria. Thank you, Orville. Just Maria, does everybody see the PowerPoint?
Yet not. I just see you.
Got it. Okay, here we go. Here we go. Okay. Everybody sees it now, right?
No, yes.
Beautiful. Okay.
Yeah, perfect.
So hello everyone. My name is Martin Chera. My company's Express Capital Financing. We're real estate lenders, and we're here to educate this forum over here about where the market's going, how to find properties, what to look out for, and is it a good time to be buying? Is it maybe possibly a negative time to be buying? I just want to say that I'm happy that my company is part of the Real Estate IQ. I always tell all my investors that there is never going to be a property knocking down your door and you're going to make money and you're going to make $100,000. You got to spend the money, whether it's website subscriptions, whether it's your own marketing, whether it's mailers, whether it's driving for dollars, whether it's postcards, and like Oliver was saying before about skip tracing. So, you need to have your tools ready to start buying properties. And Real Estate IQ, like I said, we're part of affiliation with them, and a lot of my investors are using them and having very good positive results. The market right now with the inventory is tight, it's skim, it's scarce. But when you have, realtors, bankers, wholesalers, website access to companies like Real Estate IQ or other websites where you can get a subscription based of distressed properties, that's where you're going to become successful. So with that said, I'm going to start the presentation. I'm on the left. I'm Martin Chera, the CEO. Maxie Chera is one of my sons who was with me in the company. We're a father and a two-son team. We've been around for about 13 years. We specialize in fix and flips, ground-up construction, and 30-year debt service permanent financing. So and before I go to the presentation, I just want to say, whatever I'm saying, it's advice, it's experience, and education. As always, speak to your professional accountant or lawyer for your own personal business. Whatever I'm just saying here is for educational purposes. So the philosophy is using OPM, which is other people's money, to get a higher return on the investments and all of the profits. Using someone else's money, not only is it safer, but can give you a larger return on the investment. So folks, I want you to picture if you have 100 grand cash in your pocket and you're going to buy that house on the screen, and it's going to make you 100,000 profit. Your own cash, $100,000, and you're going to make $100,000 profit. You made 100% return. But if you went to a lender and they're giving you 10% down, 90% financing. Well, now you're putting down 10 grand on the same property and it's still giving you the same results of 100 grand. You just made 900% return on your money. So that's why using other people's money as leverage is key, is because your other 90,000 or your other capital, it should be diversified into multiple, multiple cash flowing, products or real estate. Even if you're doing stocks, bonds, anything that you're doing, your own business, but don't take all of your hard-earned cash and put it into one particular project. Better to diversify your portfolio, stocks, bonds, real estate, or maybe different types of real estate. But that's is where leverage is key in other people's money. A lender is taking on that risk of the 90% or 80% or whatever it may be. And you're the investor that's just putting in 10, 20% skin in the game. But think about it, now your returns are greater. And when investors tell me, well, I'm going to use a family or a friend and I'm not paying any interest and I'm not paying any points, but typical terms are they have to give them 50% of the profit. Well, if you're going to pay interest to a lender, let's just call it 12% on an annual rate, and that's 1% a month. And let's just say 2 points. So if you kept the deal out for 1 year, you paid the lender 12% interest plus 2 points is 14. Imagine if you kept the deal out, the project out for 6 months. Well, now it's 6% because it's only paying interest on what you use, no prepayment penalties. So 6% plus the 2 points is 8. So whether you're paying 8%, 9%, 14% a year, it's still cheaper to use a lender versus your capital partner of 40 to 50% of the profits. So I just want to bring that to your guys' attention. So is everybody ready to buy an investment property? The pros and cons of buying an investment property. What type of loans are out there for investors? Calculating debt service financing coverage ratio. And that's what this, PowerPoint in this presentation is about debt service, how to calculate a return on the investment, and ways to find real estate investments. So I get, as a lender, I get calls every day. It's hard to find properties. Properties are going up in value. The market's tight. The rents are tight. I get it. I'm a lender. I'm an investor. I'm an investor, and I'm a lender. What I'm trying to say is there's never a wrong time to be buying. When people, the smart and wealthy investors who bought in the financial crisis of 2007, 2008, those were very smart people because they bought when there's a downturn, they bought when there was opportunity. I always believe when there's uncertainty, there's opportunity. And there's uncertainty now because nobody knows if the feds are going to raise the rates. Are we going to be in a volatile market, even though we are somewhat? Are we headed into a recession now because we've had so many rate hikes in the past, 12 to 18 months? Nobody knows, but uncertainty creates opportunity. And in real estate, you buy real estate and wait. You do not wait to buy real estate. And I bought properties at the height of the market, and many people have also. Is it wrong? No, not necessarily, not unless you're doing it strictly for appreciation. But a piece of real estate has value, appreciation, it has rent increase, and you own the property and you could do whatever you want with it. You could sell it, you could refinance it, you could take the refinance and buy more properties. You could sell the property. Yeah, you're going to have capital gains, and then you could do whatever you want. So owning an investment property is the way to create and maintain massive wealth in real estate. Just to touch on passive income versus ordinary income. Ordinary income is your day job. You're 9 to 5, you're 9 to 6, you're making 50, 75, $100,000. You ain't going to grow from that. But with passive income, when you have real estate, you have passive income that's coming into you automatically. Are there challenges? Yes, we're going to go through those challenges now in the PowerPoint. You have to be able to handle it. Like I said, are you ready to buy an investment property? These are things you need to think of. But like anything else, there's always going to be challenges, whether it's buying into a business, buying a piece of real estate, going into a marriage. So things to consider. Are you financially stable? If you're doing a hard money loan, typically the lender wants 10, 20% down. Do you have that 10, 20%? Do you have maybe a little more liquidity and just in case things do turn around? Look, we had a worldwide pandemic of COVID. Now we're possibly going into a recession. Now the rents are in some states and some sectors, they're going down a little bit or they're just stabilized. So if you're financially stable, not just of the deposit money of the 10, 20%, but if you're financially stable, to have the carrying costs cover you, whether you're buying a property to fix and flip or buy a property to buy and hold, you need to have some cash in the bank. How about if there's 3 months or 6 months where you have no tenants or the tenants are just not paying, you still need to pay the mortgage and have your credit, being up there. Second bullet is the ROI, which that stands for is the return on the investment. Is it there? Now, do you want to take $100,000 of your money and make 10, 12, 13, 14, 15%? That is somewhat of the norm. But do you want to take $100,000 of your money to make 5%, 4%, 3%? I don't think so, because you could put that in the bank and make anywhere from 2 to 5% these days, and it's a little more safer. Yes, they're only guarantee up to 100 grand, but the point is the return on the investment there? Some people bought, right before 2007 and 8, they were just looking for appreciation. Some people even bought in the last year or two because prices were just going sky high because rates were so low and everybody just wanted to buy and everybody just wanted to be a landlord, which is a great thing. But you need to make sure that the return on the investment is there. Do you have time to manage, or are you willing to hire a property manager? How is the housing, the market prices, the trends? You need to study your markets, whether it's websites, a realtor. Maybe a good lender will be able to help you out and sharing some insight, best practices, and ideas. Maybe buy yourself a partner. But do it yourself or go with a partner. Like I said before, if you're going to go with a capital partner and he's going to take 40, 50%, and it's your first deal or two, it may pay to do it. It still may pay to do it because think about it. You're leaning on him for the educational purposes. I'm not saying it's right. I'm not saying it's wrong. People have leaned on me many years ago because I got to be experienced. I didn't have that. I didn't have that capacity then to lean on somebody. But the point is that sometimes it may be in your best interest to do it. But if you're financially stable and you could mentally and financially able to handle being a landlord, then this is for you. Property taxes, we all know that they're going up. Insurance is going up in a lot of different states right now for various reasons, whether it's the climate, or just a lot of claims going out there, and especially these storms. These are things to factor in. So the pros and cons of buying an investment property. The pros are the ability to use other people's money, a lender, maybe a capital partner. You're reducing your volatility. Like I said before, you're diversifying. You're not putting all your eggs in one basket or just keeping it in the bank. And by the way, when you keep it in the bank, that is my opinion, and most experts will tell you it's the worst thing you could do, especially now in an inflationary market, because your last year's 100,000 is probably going to get you 90,000 worth of purchase power. 2 years ago, that 100,000 is probably going to get you 80,000 purchase power. Why? Because of inflation. The best way to hedge inflation is through real estate. Why? Because values go up, rates are usually normally stabilized 3, 4, 5, 6%, and it's the best way to hedge inflation. So if you have 100,000 into a property and it's making you 10%, and even if the inflation is 6 or 7%, even though now it's about 5, you're still 5% hedging inflation. You get unparalleled tax benefits. As an investor, you're able to take your capital project cost, divided over 27 and a half years, which is called forced depreciation. It's not a question if you want to do it. The IRS mandate that you do it, mandates. And that's excellent because it amounts to about 3.63% of the income of the property. So if the property is giving you, $10,000 cash flow, well, now times it by 3.63, that's about $3,600 less in taxes that you're going to have to pay to the IRS. It's in your pocket. Appreciation potential. Most properties go up in value. Cash flow, like I said before, is the passive income. The ability to leverage that asset for new ones. When you finally have enough equity in your property, 2, 3, 4, 5 years, most smart investors, they capitalize on that leverage. Instead of going into their own pocket, they're buying property, the second one and the third one by leveraging the first one because it increased in value. The rates will go down, your rents are going up, you're in a better position. So it's a great way to increase your portfolio of real estate. Now, the negatives, the cons. It's a steep learning curve for anybody new out there. Is it scary? It's scary. Anything new is scary. Getting married is scary. Driving for the first time is scary. So if you take that out of your mind and you focus on learning, whether it's through an experienced investor, whether it's through family and friends, sometimes, and by the way, I can help you as a lender, connect you with some people, people that don't have the cash, but they're experienced. So I can connect you with some people, but it's a learning curve like anything else in life. Don't be intimidated by it. Maybe you want to hire a property manager. There's going to be carrying costs, and you do need to know your exit strategy, whether you're buying and fixing as a rehab, whether your exit is going to be a flip, or if your exit is going to be permanent financing. But even if you're buying a house that doesn't need a rehab and you want to start to build your portfolio of cash flow, you still want to know your exit. Am I selling it in 2 years? Am I keeping it for my family for the portfolio? I want to build my, massive wealth and have a portfolio of multitude of properties. So it's important to know your exit so you can, in a way, buy right, because not always is buying right the price. Buying right is you're having a plan. I'm buying, fixing, and flipping. I'm buying, fixing, and keeping. I want to have 10 rental properties this year, and I'm going to focus on how am I going to get there? How many realtors? How many wholesalers am I going to be connected to? How am I going to find properties? I have enough money for a certain amount of properties. So this is all, having somewhat of a plan. The next idea and thoughts are loans for investment properties is going conventional, unconventional, hard money private, home equity loan, commercial investment property loans, and portfolio. I'm going to go backwards and then I'm going to shoot up. Portfolio, it just means a multitude of properties, whether you want to buy 6 at a time or 2 at a time or even 16. That's what a portfolio means. Number 5 is a commercial investment property. Commercial, as me as a lender, that means anything that's 5 units plus, mixed use, industrial, retail, warehouse, shopping center. That's a commercial investment property. Number 4 is a home equity loan. You could use that for your down payment, your 10, 20%. But I want you to think about it. If you're doing that, you are 100% leverage, 80% or 90% from the lender, and that other 10, 20% is coming from your home equity. If you lose the property or the project, you can get thrown out of your primary home because of your home equity. So what I'm trying to say is it's not the greatest idea, but if you have no choice, I did it years ago, but that was like 30 years ago. Think about it, discuss it with your spouse, maybe discuss it with your attorney or accountant, but it is a way for you to get started if you don't have the equity side. Number 3 is the hard and private money lender. Unconventional is going to a bank, and then the conventional is also going to a bank or a credit union for specific types of properties. So if you're going to buy a property for the cash flow, I'm a non-bank debt service lender or a non-bank permanent lender. It's very similar to hard money, and hard money is not a hard way to do things. It's not a hard process. It just means it's an asset. It's a hard asset. It's standing up and it's a hard asset. So same thing with the debt service. It's all about the asset income and the asset expenses. Nothing to do with you as the borrower. No tax returns, no W-2s, no income verification. If you went to a bank and borrowed to buy a property, a 2-unit, a 3 or 4 for an investment purposes, they're going to be doing what's called a global debt service. They're looking at you for your income and expenses, which is your tax returns, W-2s, and income. And then they're going to also look at the property. But most banks, especially in today's market volatility, they want to know that you have the income capacity to afford the mortgage payment besides your everyday ordinary expenses. And that's challenging in today's market. And that's why it probably, most times it pays to go with a debt service lender or non-bank lender. Like I said, no W-2s, no tax returns, no income verification, and it's under an entity. It's not under your own individual name. Unlike a bank, which wants your own name. When a bank wants your own name, you're open to liability risk, and you're not going to get that forced depreciation that I mentioned of 3.63% of your gross income on the property. So it is not in your best interest to put it, with the bank. Yes, the rates may be a little bit lower, but the disadvantages of bank are you're going to get it under your own name. So it's challenging for general liability risk. And also, you're not going to get that forced depreciation. And by the way, when you have it in your own name and you may want to buy your own property now to live in, or maybe you just want to buy another property, keep in mind it's all about the global debt service, which is your income, your personal income. You may be able to get the bank to give you financing on the first property, but how about the others after that? But, most smart, savvy investors would rather go this way. No tax returns, very easy process, 30-day to close, unlimited amount of deals because we're not looking at your income. So what is debt service? You're taking the operating income. Let's assume it's, 12,000 a year, 1,000 a month, 12,000 a year, and then you're taking the total debt service. When we say total debt service, it's the principal, interest, taxes, and insurance. So again, let's just say, for example, the payment to the mortgage is 1,000 a month, over 1,000 a month in income on the property. That's zero. That to us means 1.0, which means exactly whatever the income is coming in is the expenses are going out. Me as a lender, it's fine. I could deal with 1.0. Most lenders, they want a 1.20 debt service. What that means is they want 20% more cash flow of the rent coming in. So if your rent coming in is $2,000, times it by 1.20, your mortgage payment should be around 2 times 2 it should be around $1,600. They typically want 20% or more, cash override coming in. So the income and expenses are the details of the property only. Like I said before, taxes and insurance is your principal, interest, and taxes, which is called PITI, principal, interest, taxes, and insurance. So here's an example. If you take a purchase price of $250 and we're going to give you 75% leverage, again, this is just an example. So your loan amount would be 187. Principal and interest is 1409. Assuming your taxes is 2,000, your insurance is 12. So your monthly income and rent is, again, all assumption of 2,000 a month, which is 24,000 a year, but your PITI payment is now went from 1409 to 1676. If you look to the right, your debt service is 1.19. So you're having about $437 left over, which is that 20% left over. That's what most debt service lenders want. That's good. But again, just to let you know, if you're bringing in 2,000 a month and your PITI payment is 2,000 a month, with me it's fine. It could be zero. So that's what debt service means. So what is the return on the investment? If you remember what I said before, if you have 100,000 cash, you bought a property, it's going to make you $100,000. You made 100%. That's a return on the investment. Same example, if you took a lender and you got 10% down, which is 10K, your return on the investment on your 10K, if you're selling the property and you're going to make 100,000 profit, well, your per return is 900,000. Well, what happens if you're keeping the property and again you put down $10,000? So I'm going to explain that to you on the next screen because it's all about the cash on cash. How much should I put into the deal and how much is it bringing me on a yearly basis? Because if I put in $20,000 cash into the deal between down payment, closing cost, lawyer, title, and all the things that go in with a purchasing an investment. And if it's throwing me off 10%, 15%, that's good. That's good. That's your cash on cash, which is another word for return on the investment. So exactly what the ROI, what I said was the bottom is your cost of the investment. It could be the total purchase price and then divide that over the gain. or it could be your down payment over your NOI, which is your net income that you're going to be making. Keep in mind that um, repair maintenance, such as expenses, you need to figure, well, that's going to be coming out of your NOI. So it's not really the cost of your investment, because if you're putting in 20 grand, you have no idea if you needed a roof that year or central HVAC vac. So in those cases, you're just going to have to, do it at the end of the year and figure out what your NOI is. So let's go with this case scenario. You paid 100,000 cash for the rental. Your closing costs were $1,000. Remodeling is 9. That brings you to 10,000. Your total project cost is 110,000. Again, assuming all cash, and you collect 1,000 a month in rent. A year later, you earn 12,000 in rental income. Your expenses, taxes and insurance and water, in this case scenario, is $2,400. So your annual return is 9,600, because the 12,000 of annual income minus the expenses is $2,400. But how much did you put in? 110. So 110 divided over that $9,600 of income that you're getting, you're making an 8.7 return on the investment. So is it bad? No. What is the norm? Anywhere from 6 to, depending on the property type and the county and the state and all that, depending on a few factors, 6 to 15% is a decent return on the investment. But again, even if it's your first deal and you're making slightly less, what's wrong with it? You're learning, you're educating yourself, you're getting experience, and you're feeling comfortable. And after one deal, you're going to have somewhat of experience for your second. And don't pound yourself on the head when you make mistakes, not if, because you're going to. Expect to make mistakes, but treat it as not a mistake, as a learning curve, and have your mindset, I just learned something from here to do better, not to do it again, and protect myself for the future. Because I have investors and I meet people, oh, I did 3 deals, I lost my shirt, I did this, I did this, I did that. Nothing is going to be gravy. Nothing is going to be easy. It's a learning curve. You have to learn, whether it's books, podcasts, through your own experience. Life experience itself is the best type of experience you're going to get. And again, don't expect to be perfect, because no one is perfect. No one is perfect. Okay. Now, assuming you bought the property for the rental property as above, but instead now paying cash, you took out a mortgage. So you did a down payment of 20%, so $100,000. 80,000 is coming from us, $20,000 is coming from you, which is called sweat equity. The closing costs were higher, which is typical for a mortgage. Let's just say it's $2,500 up front. The same deal, 9,000 for the remodeling. Your total out-of-pocket expense between the down payment of 20 grand, 2,500 for the closing cost, 9,000 for the capex. You're in out of pocket for a total of 31.5. But you bought the property for 100. How much did you make, folks? If you remember, you still made $9,600, but now you got a payment. Now you got a payment on here. And so if you look at the bottom, this is an old rate, of course, but assuming a 6% rate, $80,000. So your payment would be, $479 a month. We're going to add the $200 to cover the expenses. So that's $679 a month. So your $12,000 a year in income minus your cash flow comes out to $320. $320 times it by 12 months. If you look at the right, that's 3,800. How much did you put into the deal? Roughly $33,000. You made a 12% return. So look where I said leverage is king. Leverage is unbelievable. So you're making a greater return, less risk. Instead of putting in $110,000, you put in $33,000. You're taking your other cash and diversifying it and growing your portfolio. Again, stocks, bonds, gold, real estate, another property, whatever it may be. And this is why your return on the investment is always greater when you leverage other people's money, which is OPM. Other factors to consider: equity, the market value of the property minus the total loan amount outstanding, repairs or maintenance costs, vacancies, particularly in between tenants. Like some of my properties, I have seasonal tenants, winter and summer. So some, thank God I don't have any vacancies there, but you could run a vacancy. My summer tenants, they're paying me over here on the Jersey Shore on the East Coast, a lot of money to be by the Jersey Shore. Some of my houses have pools. I get anywhere from 40, 50, $60,000 just for the 2.5 to 3 months. But what happens if I can't rent it out for the winter time, even though it's a much lower rent? So, these are things to be concerned about and to have, in your spreadsheet, some rules. You need to have some cushions there. Are you financing it or mortgaging it? The less cash paid up front as a down payment on the property, the larger the mortgage loan balance will be. Again, the less cash paid, the more leverage you get, obviously the higher not only the loan balance, but your payment. But that's okay, but your greater the return on the investment. So conversely, the more cash paid up front and the less you borrow, the lower your return on the investment. And that's why I say leverage, leverage, leverage. Now, do you over leverage? Some people are over leveraged these days because for whatever reasons. Look, smart lenders learned their lesson from 2007 and 2008. And that's why we don't have a financial crisis from the worldwide pandemic of the COVID. If you notice, we didn't have, a financial crisis. Banks got into trouble, but nothing to do with values, nothing to do with over leveraged loans. The bank fallouts is a wholly different topic. I'll just touch on it a little bit. They were lending interest at, 3-4%, and then they were paying the depository people, 1%. But now when the rates are 6, 7, 8%, they can't pay the depositors such a low amount of 1% a year, and yet, have these loans out for 3% when they need to do it at 6, 7%. But just going back to the return on the investment. So again, hard money, 10, 15, 20% down on a permanent debt service financing. Typically terms are 80% of the purchase, 20% down from the borrower. How to find real estate deals. Well, obviously REIQ is a great way to do it. It's a great platform. Like I said, I got many of my investors, calling me up. I can't find properties. I'm aggravated. I'm upset. I'm not happy, this, that, the other. And I tell them, get over your emotions. And if you want to be in real estate, well, take the course. And like I said before, you have to spend time in the market, don't time the market, and you buy real estate and wait. But spread the word. Tell people that you're an investor. This is what I do, families, friends, and everybody else. Look at newspaper ads, do drive-bys, use real estate website like REIQ, network with other real estate professionals. Who's a professional? A realtor, a banker, an attorney, a probate attorney, a real estate attorney. And then how about wholesalers? Hire a real estate agent. I'm going to go back to the middle bullet about REIQ and real estate websites. I always tell my borrower there's not going to be property, an owner saying, Mr. Buyer, here's my property. You're going to make 50,000, 100,000. Deals are not found. They are created by buying into a website subscription. You're looking at distressed properties. You're searching, you're filtering it, your city, your state, the price range you want, the property types you want. And then you could take that list and you could do multiple things. You could do mailers. You could do drive-bys. You could do like Oliver said and do a skip tracing. And for the folks who don't know what skip tracing is, you got a property address and you don't know who owns it. You don't know who the owner is and his contact information. Well, that's where skip tracing will come in. And that's great, by the way, for vacant listings and vacant listings and out-of-state landlords. How many landlords who own a property, whether they bought it, themselves out of state, or even in landlords who got the inherited properties from COVID or whatever reason, they just got it inherited. Their parents own a property in a different state. Well, you could find these owners on these websites. under vacant listings or vacated listings or out of state landlords. You got to filter it. And don't be afraid, whatever the subscription is, whether it's $50, $100 a month, whatever the number is, you got to spend money to be in a business. You got to spend money to make money. There is not a business concept in the world where you're going to make money with no out-of-pocket expense. And you could take the best franchise in the world, whatever it may be, whether it's a 7-Eleven, a Dunkin' Donuts, you could be in the best prime location, spend $1 million to buy it, a McDonald's that costs millions of dollars. If you don't know how to market yourself and take care of the business, it ain't going to make you the money. You got to take care of the business. You got to nurture it and market it and be hands-on. So other ways that you could find real estate properties that I don't have listed over here, um, is the networking. Networking also, it could be Chamber of Commerce, which I don't really recommend, but Rotary clubs. Another great website is called meetup.com. You could find real estate meetups in your particular city and state. Don't just go once. I always tell my investors, go, go, go. Show your face, have business cards. You never know when you're going to meet a realtor, a wholesaler, a landlord that just says, I want to sell, help me out. And for the folks up there who don't have enough money yet to get started, that's okay. Like I said before, partner up with somebody who has maybe the liquid or somebody who has the experience. And when you're meeting up with people at these networking events, that's part of your growth. And I have three words that I always use is networking is an opportunity to grow. Networking is going, the opportunity is shaking hands with everybody, but that growth is tomorrow. When you met everybody tonight is to grow and call them tomorrow. Nice to have met you. I liked what you had to say. How can we work together? And how can I help you? And how can you help me? That's what it's all about. So just to end it off, on the left side, you'll see is the rental loans we've been talking about. Our product right now is 75,000 minimum. This is a little bit old, forgive me, but the loan amount maximum, is $5 million. Rates right now are going to be somewhere in the 8%. Credit, I can go down as low as 620, not even 650, 620. Max leverage, disregard this, forgive me, but it's 80% if it's a purchase. Cash out is 75. Actually, it says it on the bottom. I'm sorry. So maximum on a purchase is 20% from you guys, 80% from us. And if you're doing a cash out, 75%. If you look all the way to the right, fix and flip, 75,000. There is no max. Rate right now are 10%, an annual rate. An annual rate, it's pro rata, no prepayment penalty. So if you kept the deal out for half a year, you just paid us 5% interest. Don't worry about the credit. We're not credit sensitive. No financials are required. Max leverage could be 90% of the purchase. Anybody doing a no doc commercial again to us means mixed use, multifamily, industrial, and retail, 100,000 up to 15 million. Again, rates somewhere in the eights, 75% max leverage. And for the folks out there who anybody is doing, these days, multifamilies or mixed use, that's our commercial bridge, 10% plus. Again, we're not credit sensitive, no financials. Here's how you could reach me. The 201 number is my office number. The 347 is the social. You have my email there. We're a nationwide lender. And even if you don't have a property, you'll want to find out about products, programs, a deal, just, digressing the deal to show you what the returns and your investment will be. I can gladly help you, and I can help you with realtors, wholesalers, REIQ, and to help to get you find these distressed properties. So that's it from my side. I hope everybody gained a lot of information. I'm open for questions. Maria, if there's any questions. Anybody have any questions? You could put them in the Q&A. No one? Maria, you hear me?
Yes, I'm here.
Okay. So there's no questions I see being asked?
Yeah, feel free, everyone, that Martin is here to ask all the questions that you may have.
Got
If
it.
not, feel free to reach him on his social media accounts or phone number or email address too.
Got it. Okay, so here's a question. Thank you so much, Sharon McGlover. Thank you so much for that. Look, I get asked every day, where do I see the market trending? Nobody has that crystal ball, but I will say most likely that the Feds are going to be raising the rates, to what I'm hearing, 1 to 3 more times. Can it be more? Yes. Can it be less? Yes. But let's be transparent. You know, the cash infusion of trillions of dollars into the United States of people that was, transfused into people's pockets, we were inevitably going to have what we have now, which is inflation. People had cash, whether it was more or the first time, and whether they were paying their rent with it or groceries or they bought, items with it or properties. You have more money, you're going to spend more. So we had inflation. With that said, the Feds need to curb it, bring it down to that 2%. I believe right now that it's, I think 3, 4, 5, whatever the number is. It's going to take time. It's still going to be another 1 or 2 years more. My perspective, when there's a new president in late 24, 25, there's going to be, more stabilization. My perspective is that the rates will be probably in the 6% range. And as time goes by with the new president, we'll probably be in the 4% range. I'm always telling investors right now, also when they're doing the debt service financing, yes, they're going to be in the eights, but it's a temporary setback. If it's still cash flowing, that's the main thing. And don't forget, it's not ordinary income, it's passive income. Keep in mind, today it's at 8%, but in 2 years, when it goes back down to normalcy, your values will be higher, your rents will be higher in 2 years. You don't sell, so you have capital gains. You do a cash out, and guess what? It's all cash to you. You have no capital gains. So you'll get more cash out, a lower value, and probably, with more higher rents. So that's just, it's not even my perspective. These rates right now in the 8% environment, we were here. We were in this in 2017, 2016. About 20 years ago, we were in the rates of 15 to 18%. So we've been there before, which America's just spoiled, and we're so used to a rate of 2 to 3, 4% that when we hear 7 or 8, we're panicking. But how about all the investors who last year bought a property at 90% leverage with the hard money? And, we had to make sure that it debt serviced at the time last year at a 6% environment. Nobody ever thought it was going to be 7 or 8. And guess what? It doesn't debt service. So those investors are forced to either keep on renewing the hard money at the, whatever the rate is at the time, or they need to go into perm if they could. But just keep in mind, we could do it on a debt service of 1.0, which means it could be zero cash flow. So Amy is asking a question. Excuse me, I'm going to go to Amy first. Can you speak to your process? How quickly can you evaluate a deal and turn around letters? I could turn around a deal in 5 minutes. You give me some numbers that I need, you call us up. We're not just going to give it to you verbally. We're going to show it to you on a shared screen so you could see everything, feel comfortable, and get the proof of funds. And by the way, a good lender is going to make sure that you're profitable because we want to get paid back, whether it's a hard money or long-term perm. Our goal is, number one, for you to make the money, but number two is for us to get paid back. So we're making our money on the monthly interest, but if you don't pay us back that hundreds of thousands of dollars, not only what did you lose? You lost a small deposit. We lost a large capital infusion. So a good lender is going to have your back. So that's very important to know. But proof of funds and in analyzing a deal, it just takes us a few minutes on the phone. Jamie's question is, what would be the requirements to lend on a 20-unit apartment building for a term of at least 5 years or more? So Jamie, I'm going to go to one step back on the page, which is the commercial bridge. It's not 500. Forgive me again. This is a little bit old. We reduced it. 250,000 minimum loan amount. The max is 10 million. Interest rate could be 10, 11, or 12 on an annual rate. Mixed use multifamily, that was your question. So we could cap it out at 75% of the purchase and 100% of the rehab. Even, and by the way, hard money, which is the fix and flip, the commercial bridge, the property can and probably will should be empty. You're doing it to buy it and fix it to get to a new after repair value. Whether you want to keep it for the cash flow or not, that's what hard money is all about. Empty properties, dilapidated properties, and things like that. And by the way, another thing I want to add, since I'm a lender and I study the capital markets, there's going to be a lot of distressed properties coming to the market. Office space has already been hurting for quite a few years due to COVID. I'm hearing industrial is still strong. Retail is somewhat hurting. Okay, we may not be in that sector of that property type, but the borrowers, whether they're a homeowner or investor, for some reason that was not capital rich at the time when they bought it, and there's an increase in foreclosures, there's an increase in pre-foreclosures. So it's a great time to be buying and creating a list and do your job. Do your job of doing what you have to do. And I'm going to add something else. I'm sorry to kind of repeat myself. Don't be embarrassed to keep on calling whatever it may be, the realtor, the wholesaler, your lender. Constantly call. And even if you networked with somebody that you feel that you could do a deal together, I once went to a networking event where I met a real estate investor. He happens to be a lawyer. I'm not using him for lawyer practice. Me and him now are looking to do self-storage units together, me and him as partners. So you never know how these networking events can, to be fruitful for you. So Miriam is asking a question. Do you see opportunities for distress in New York City or Florida? How can we monitor more of the distressed portfolios of the banks instead of one by one on the website? Well, the only way you're going to find distressed properties from banks is it's the county clerk or the county office assessor's office. So just you're taking New York for an example. So Brooklyn, New York, or Queens, New York. You'll look at the county assessor, the sheriff's office on the website. You'll see how many properties are coming up that particular day. You need to look at what the lien amount is, who the bank is. Maybe call up the banker and see what's happening. Call up the lawyer and see if there's anything you could do before it hits the sheriff and goes to a foreclosure. So sometimes if you're savvy enough and you're experienced enough, you could buy it at a foreclosure. But if you're not experienced, buy it pre-foreclosure. Talk to the lawyer. Talk to the banker. Talk to even the homeowner. And that's by doing a skip tracing. If it's not on the county assessor's website, do a skip trace and find out who owns it and say, look, I see this information here. I'm a real estate investor. This is my business. I see that you're in distress. How can I help you? Deals are created. They are not found. You may find a distressed property, foreclosure, pre-foreclosure, probate, tax lien, whatever lien, but it's all about finding out the distress in the seller. Does he want to get out quicker, slower? Does he want you to buy the house as is and take all the items in the house? Does he want you to find him a new home, to find him a new rental? So this is where deals are created. It's having the conversation and being comfortable with these types of conversations. I hope I answered everybody's questions.
Okay,
Don't be
so
shy.
in case
I want to answer
Yeah.
questions. I love getting.
I was about to say that. We encourage everyone to
Don't be
make
shy.
sure
Don't be shy. Oh,
we have a
okay,
new
looks
one.
like here's another one. For new purchases of apartment building units with occupancy, we have an opportunity to increase rents up to done. So if the property is not fully stabilized, you still have to do a hard money bridge. So until it gets to 100% occupancy, we need to do a hard money bridge. And again, it's 12 months interest only. And I want to set a mind frame here that if I told you 12%, don't think of it as 12%, oh my God, because it's not for 30 years. It's 1% a month. And if you're keeping the property and the loan out for 6 months, it's 6%, 7%. It's better than taking on a partner than giving him 50%. And that lender is OPM, other people's money, leverage, and you're putting in as little risk as possible. But to answer your question, it will be a hard money bridge. Are you able to connect the investors with each other that are in the meeting? So I guess, Maria, that would be more your question. Steve Portia Thomas is asking if you can connect everybody here so everybody can connect together.
Well, yeah, so we share actually the list of attendees to you. But I can also, Thomas, send you the list to you too, in case you want to have everyone contact information without any problem. If anyone, if everyone else is okay with that, for sure.
So you're gonna give it to me and then you want me to give it out? Is that what you're saying?
Yeah, I will send it to you as soon as the meeting ends, either today or early tomorrow. And in case you want to share the information with someone else, you can do it. And also, if not, I can send it directly to him.
Okay.
Of course, if everyone is okay with that.
You got it. So anybody that wants to connect with anybody here, I guess reach out to me tomorrow and I'll do my best to connect you. Yeah, it's all about relationship. Networking is an opportunity to grow. You know? Okay. Maria, Oliver, I appreciate it so much. Everybody that joined here, I appreciate your time. I hope I was incentivizing and I hope I provided you a nice resource of information. And just keep on buying. Don't be scared. As long as the numbers make sense, that's all that matters. And I want to add one more thing. Emotions lie, numbers don't lie. When my investors tell me I was outbidded by 10 or 15 grand, well, instead of making 65,000, now you're going to make 55, 50,000. What's wrong with it? What's wrong with it? You know? So you have to go with numbers, not with emotions.
You're amazing, Martin. Thank you very much
You
for your
got
time
it.
and
You
for
got it.
sharing
Okay.
expertise with us.
Thank you,
It
everyone,
was
and have a
amazing
great
webinar.
night.
Thank you very much. Hope you have a great night too. Have a good one. Bye.